Welcome to the Deep Dive. Today we've got a really fascinating stack of sources on one of the most famous contrarian investors out there, Michael Burry.
The guy from The Big Short?
Exactly. The man who was spectacularly right about the 2008 housing crash. And we're here to unpack some, well, pretty shocking news about him closing his fund right after placing these huge bets against AI.
Yeah, we have to start right there. It's confirmed across all the material. Burry is shutting down Scion Asset Management. We have the letter, and the official SEC database shows its registration was terminated November 10th, 2025.
So Scion was a hedge fund. It was managing, what, about $155 million of other people's money? And when a guy with his track record just suddenly closes up shop and then he teases something about much better things November 25th, you have to ask what's going on.
Right. Is he retiring? Or is something bigger happening? And what does it mean for these massive bets he just made?
Okay, so what is the actual mechanism of the exit? He's not just disappearing.
No. He's stepping away from managing outside money. That's the key. By closing Scion, he's basically freeing himself from all the regulatory stuff, the reporting.
And the clients.
And most importantly, the clients. He's shedding that psychological burden of people who might want their money back at exactly the wrong time.
It seems like the next step is a family office, right?
Yeah.
Just managing his own capital privately. We've seen other big names do this.
Yeah, people like Tepper and Druckenmiller. It's a common move for freedom and privacy. But with Burry, you're right, it feels different. It feels like he had to do this.
Because it all traces back to that first Big Short, doesn't it?
It absolutely does. This is him trying to prevent a repeat of the most agonizing part of his career, the part that, the movie really highlighted.
Let's unpack that for a minute because it's so critical. Before 2008, he wasn't wrong about subprime mortgages. He was just early. What happened?
Well, being early when you're managing other people's money is sometimes indistinguishable from being wrong.
Right.
The market kept going up, his positions were bleeding money on paper, and his own investors started to revolt. They demanded their money back.
So he had to fight a war on two fronts. He was fighting the irrational market, and he was fighting his own clients who were losing faith.
Exactly. And the sources we have make it clear he sees a parallel between that situation, the mispricing of those mortgage bonds, and what he sees in the market today. He's getting ready for another long, painful period of irrationality.
So by closing the fund, he's taking his investors out of the equation. He's giving himself the freedom to be early again, maybe for years, without anyone forcing him to sell at the worst possible moment.
It's the ultimate lesson learned from 2008. He's insulating his strategy from popular opinion.
Okay, so that's the why. Let's get to the what. What are the actual bets that caused such a stir right before he closed? The headlines were pretty wild.
They were. Media ran with this figure of over $1.1 billion total bet against AI giants like Palantir and Nvidia.
Which sounds like a crazy all-or-nothing bet.
It does, but it's also completely wrong. The media just fundamentally misunderstood what they were looking at in the SEC filings.
Okay, break that down for us. What did they miss?
They missed the huge difference between notional value and the actual cash he spent.
So notional value is what? The theoretical value of the whole position if it were stock.
Exactly. When a fund buys options, the 13F filing requires them to report the value of the underlying shares, the option controls, not what they paid for the option itself, which is called the premium.
So it's like paying a $10,000 deposit to get the right to buy a $10 million building. The filing would report the $10 million, not the $10,000 you actually spent.
That's a perfect analogy. The $1.1 billion is the building. The actual cash he put at risk is just the deposit.
So let's get specific. Palantir was the big one. The media said a $912 million short. What did he actually spend?
He spent $9.2 million.
Wow. Okay. That's 100 times smaller.
It changes everything. For $9.2 million, he bought the right to control 5 million shares of Palantir, specifically the right to sell them at $50 a share in 2027.
So this isn't a crazy, fun-destroying bet. It's actually a classic Burry move. He's risking a relatively small, defined amount of cash for a potentially massive asymmetric payoff if he's right.
It's pure leverage. High risk, high reward, but with a very controlled downside. His actual cash at risk is tiny compared to his portfolio, which is how he can afford to wait for the market to come around to his way of thinking.
All right, so now we know the real size of the bet. The big question is why he's making it. What is his core thesis against AI, a sector that everyone else seems to think is the future?
Well, his argument isn't really about the technology itself. It's about the accounting.
The accounting.
Yeah. He flat out believes that big tech is committing accounting fraud. He calls it one of the most common frauds of our time.
Okay, fraud is a very strong word. Is he alleging something illegal, or is this more like aggressive but legal accounting gymnastics designed to mislead?
That's the million-dollar question. He uses the word fraud. The mechanism he describes, though, is basically companies manipulating their depreciation schedules.
Okay, walk us through that.
Sure, so companies like Meta, Microsoft, Google, they're spending hundreds of billions on AI hardware. GPUs, servers, data centers.
Right, stuff that gets outdated really, really fast.
Exactly. The tech is moving so fast that this hardware might only have a truly useful life of, say, 2 or 3 years before it's obsolete.
And companies are supposed to write off the cost of that equipment over its useful life.
They are. But what Burry alleges is that instead of using a realistic 2 or 3 year window, they're stretching the useful life on their books to 5, maybe even 6 years.
Ah, and I see where this is going. If you spread the cost over a longer period, the annual expense looks much smaller.
Precisely. If a server costs $100,000 and you depreciate over 2 years, that's a $50,000 expense on your income statement each year. Stretch it to 5 years, and suddenly the expense is only $20,000.
And that extra $30,000 drops right down to the bottom line as pure profit.
You got it. It artificially inflates reported profits and makes the companies look far more profitable than they actually are.
So his argument is they're using this accounting trick to mask the fact that their massive AI spending isn't generating a proportional amount of revenue yet.
That's the core of it. The sources we have give some specific numbers. His analysis suggests that if they used more realistic schedules, Oracle's profits could be overstated by almost 27%.
27%. That's huge.
And for Meta, it could be over 20%. When you start slashing reported profits by that much, those sky-high valuations start to look, well, terrifying.
Which brings us back to Palantir and Nvidia.
Exactly. Palantir is trading at a forward PE ratio of over 280. Even a titan like Nvidia is at 20 or 30 times forward earnings. Burry's point is that those multiples are unsustainable if the profits supporting them are, partially an illusion created by accountants.
It's a very specific, very technical thesis, but we have to give the other side. This is Michael Burry against, well, the entire market.
It is. And Wall Street institutions like JP Morgan are on the record saying he's dead wrong.
What's their argument?
That the spending is justified. That we're in the very early innings of a technological revolution, and the massive capex today will translate into even more massive revenue growth down the line. They see it as a necessary investment, not a bubble.
So this brings us right back to the central problem of his career, timing. Is he early again, or is he just plain wrong this time?
That is the question, isn't it? And even Burry himself seems to acknowledge it. In his letter closing the fund, he said his estimation of value is not now in sync with the markets.
Which sounds like him saying, I know I'm right, but I'm tired of fighting a market that doesn't care about my spreadsheets.
I think that's a fair reading. And look at the brutal math of his Palantir bet. He needs the stock to fall below $50 by 2027 just to break even.
From its recent price of, what, around 170?
Yeah, that's a drop of over 70%. He's not just betting on a correction, he's betting on a complete and total collapse in the stock. That's an incredibly high bar.
So in the end, Scion is closed, Burry is going private. And the lesson of 2008, the pain of being early, is hanging over this whole thing.
It is. His thesis is sharp. The AI rally is built on a foundation of shaky accounting. But momentum is a powerful force, and for now, momentum is winning.
Which leaves us with a final thought for you to consider. If one of the most successful contrarians of the last 20 years decides he can no longer manage other people's money because his view of value is just too disconnected from the market's price, what does that say about the stability and maybe the sanity of the market we're all investing in right now?